Hello, welcome all to AusCham's session on capital gains and how to pay back your the money into your home. So, thank you everyone for joining us today. We have about 63 people on the line, and it's quite exciting to move to an alternate way of delivering some of the content that we have at AusCham from our partners and from our partners in a different format. So, as everyone may be aware, there's been a bit of a decision to postpone large-scale events and deliver our content online from AusCham due to the current situation with the COVID-19. Our goal is very much to continue operating or continue to bring you insights around where we can and gather people together in the most appropriate forum. So we do very much thank you for your support for the Chamber, and as we go through these very interesting and challenging times. So just to get us started, a few housekeeping rules. So we've got guests are able to ask questions during the Q&A session, which will we estimate to be just before 1 p.m. and you can click on the Q&A button at the bottom of your webinar screen. We'll only be able to answer certain questions due to time constraints, unless if there is too many, but we'll definitely get through as many as possible. So today what we're here about is to speak about the capital gains tax and your principal place of residence. For this ruling is going to change for Australian expats on the 30th of June 2020, and we're going to walk through how these changes may affect you as an expat or with Australian property. So joining us to speak about it today is Australian tax expert Tristan Perry from Select Investors, and he'll look at these recent changes and delve into how the principal place of residence exception will affect Australian expatriate property owners and give you an understanding of how you can gain access to the principal place of residence exemption if you were to sell your property either pre or post 30th of June as a foreign tax resident of Australia. So joining us is Tristan from Select Investors, and Select Investors is a key partner for the Chamber as well. So Tristan is an Australian chartered accountant. He's an Australian tax agent that has been working on Australia tax since 2004, specialising in Australian expatriates and repatriation planning intended for migrants, private clients and retirement planning. He has 16 years of experience in private client tax field, including 7 years of working in one of Australia's top private client and family office firms, together with nearly 2 years in managing a large expatriate and foreign investor tax practice in Singapore. He is on the executive committee of the Australian and New Zealand Association, or ANZA, in Singapore, and he's also on the board of AusCham in Singapore and is a regular presenter at various Australian tax events, both around Singapore and Australia. So I'd like to introduce and welcome Tristan and hand over to Tristan, who will start to run through our topic for today. Thanks, Tristan.
Lovely. Thank you, Ben. Welcome, everyone. Thank you so much for joining us today and sharing your lunch hour with me to talk about an important topic, which is the changes to the principal place of residence exemption, which will be brought upon us on the 30th of June this year. Now, I've just shared my screen, so hopefully you can all see that. My presentation will go for about 20 to 25 minutes. I'm going to run through some basic fundamentals of capital gains tax, just for those, just quickly, just so to bring us all up to speed. So for those that don't understand it, can understand how it applies. We'll go through some basic examples as well, how it works, who does it apply to, what concessions are available. So we have several concessions that are available to capital gains tax. Then we'll tackle the big issue, which is the recent changes to expatriates on the principal place of residence exemption. And I've got some worked examples as well on how that works and how it may affect you. And then a few sort of discussion points, I guess, to help those that are on the line here who have joined us today to try and make that decision whether they're going to sell their property pre 30th of June 2020 to access the concessions if they're available, hang on to the property and just or hang on to the property and make sure you understand the rules so you don't get tripped up in the future. So what is capital gains tax? So capital gains tax is the tax on the eventual sale of capital assets. So things that applies to Australian source shares, units and similar. Now, I've said a little note there, note residency. So as an Australian resident for tax purposes, you're taxed on your worldwide income and worldwide assets. However, as an Australian non-resident for tax purposes, you're only taxed on your Australian sourced assets. And for a lot of us, it's basically Australian property. If you have Australian shares that you owned during the time or any shares to the point you've owned during your time as an Australian resident, and you haven't either sold them before you left Australia or had what we call a deemed sale, they may also still be taxable to you as a non-resident when you sell them. Other things capital gains tax applies to is international property for Australian residents. So coming back to the definition of Australian tax residency, tax on your worldwide income and worldwide assets. And also that applies to those of us that may have picked up an international property during their expatriate assignment and they bring it back into Australia. So that picks up a mark-to-market valuation when you become a resident again, and then you're subject to capital gains from that point onwards. Other things like Australian source leases, goodwills, licenses, foreign currency, and certain collectibles. So things like fine wine worth more than $500 a bottle, boats, furniture, electrical goods. If you sell them and make a profit, you may be subject to capital gains tax on that. Important thing with capital gains tax is it happens at the time that you sell the property, so or sell the assets. So obviously it accumulates over the time you hold it, but the actual event happens when you sell the property or the capital assets. And you can make a capital loss, unfortunately, but fortunately you can use that against capital loss to help offset other capital gains. So you make a capital loss in the share markets whilst you're a resident for tax purposes, that loss will carry forward and you can use that loss against, for example, property in the future. Right. So how does a basic capital gains tax calculation work for property? So we take the capital proceeds, so the sell price, and then we less what we call the cost base. And the cost base is made up of things as the purchase price, the acquisition and sale costs. So we're looking at legal fees, stamp duty, commissions, advertising, etc. Any holding costs that you haven't already deducted. So holding costs that you may not have deducted for one reason or another is, say, repairs and maintenance that were missed in your annual tax filings, any improvements as well. So if you spent some money on the property to improve it, renovations and alike. However, depreciation is one of these things that we need to add back at the time of sale. So depreciation is the written down value of your property, plant and equipment and construction costs of the property. I generally always recommend for clients to get that depreciation report for their properties. However, the depreciation you've claimed along the period basically will need to be added back at the time of sale. Why do you do it? If you have to add it back, because it'll save you from that 32.5% plus non-resident tax rate during your time as when the property's growing, and also when it gets added back, it might be added back with the concessions available to it, so you're getting a free kick in there somewhere. Okay, so after you do that calculation, we then deduct any exemptions. So we've got the principal place of residence exemption, which we're talking about, the 50% capital gains tax discount, and we'll run through how that works for non-residents, and capital losses, and then we get the net taxable gain. And then that net taxable gain is taxed at your marginal rates based on your residency and other income for the year. When does it happen? So I've sort of inserted this slide on purpose because this is an important thing to note. So when you sell a property, it's capital gains tax event A1, and this happens at the time of the event is when you enter into the contract for disposal. So more so, I've had clients asking me about, do I need the property to sell and settle before 30th of June? No, you need to get a signed contract before 30th of June. In the absence of a contract, so this is point B, it's when the change of ownership happens. So that's even more reason to make sure you've got a contract in place. But generally, you've always got a contract in place when you sell a property. Let's have a quick look at the tax rate. So I mentioned after the capital gain is calculated, we then apply it to the tax rates based on your residency. As a non-resident for tax purposes, you're looking at the non-resident tax rate. So 32.5% for every dollar from 0 to 90, which is relatively harsh. So for example, as a non-resident of Australia for tax purposes, let's say you've got a rental property, you have $10,000 worth of net income. So after your interest deductions, after your depreciation, after your running costs, etc., and you're a non-resident of Australia for tax purposes, you're going to pay 32.5% on that $10,000, so $3,250. However, as an Australian resident for tax purposes, if you had no other income, you pay no tax because you get the tax-free threshold. So that's 0 to 18,200. There's a low income offset that kicks in there as well, plus the Medicare levy. So you can see the rates there. All right, basic work example. So Joe's got an investment property. So we'll look at Joe's residency in a moment. So he acquired a property for $500,000 in April 13 and sold it for $700,000 in April 18. So we're looking at a 5-year ownership period. Never lived in the property, so important to note. He bought it for $500,000, sold it for $700,000. As you can see, he's got a calculation there of his cost base, which is legal fees on sale and purchase, sales commission, depreciation, stamp duty. There'll be some advertising there as well, and he's and you can see that he's had to add back $25,000 worth of depreciation because every year he's claimed $5,000. So he's got a gross gain of $178,500. Let's look at how that's taxed. So Joe was a tax resident for the whole period, earning $90,000 in Australia. So he's already earning $90,000 of salary and wages. As you can see, that puts him in the 37 cents bracket, and he also gets a 2% Medicare levy there. So if you go back to Joe's tax calculation, he's looking at, we've got the gross gain of $178,500. He gets the full 50% capital gains tax discount because he was a resident for the entire period. It was owned after May 2012. I'll walk through how this works in a moment. Net gain of $89,250, tax at 39%, which is his marginal tax rate. We're looking at $34,808. Sue is a non-resident for tax purposes for the whole period. So Sue's an expat. She's been living offshore for the entire time. As you can see, she misses out on the 50% capital gains tax discount. So she's got a net gain of $178,500. And Sue's accordingly taxed at between two brackets of the 32.5 up to the 37 when we're looking at the rates. So she cops a $61,000 tax bill. All right. How does the 50% capital gains tax discount work? Okay, the 50% capital gains tax discount allows the gross gain to be reduced or discounted up to 50%. You need to hold the asset for 12 months to qualify for this. So this also applies to shares if you're an Australian resident. On the 8th of May 2012, the government changed the eligibility of this concession to only be residents for tax purposes. So Sue is a non-resident for tax purposes during the entire ownership of the property, and it was after 8th of May 2012, she misses out on the 50% capital gains tax discount. If Sue has been a tax resident for half the period of ownership, earning nothing in Australia, and was a non-resident for the other half of the time, basically we're looking at this. So we're looking at a gross gain of $178,500. She gets a 25% capital gains tax discount. So 2.5 years she was a resident out of the 5 years she's not. So she gets a 25% capital gains tax discount. Net gain of $133,875, and she's sitting in between that tax bracket 32 to 37 because she sold as a non-resident. Tax at $45,483. You see the difference there. All right, on to the next residence. So the principal place of residence exemption. So this is the exemption that we're talking about mostly today, and this is the one that's being taken away for foreign residents for tax purposes. I'll talk you through it. So what's the actual concession? So the concession allows you one main residence at one time, exemption for capital gains tax per person, or shared if you're a couple. So the government says if you're married, you've got deeper pockets. combined between the two of you, so you can buy a bigger house. So therefore, it's one house per couple, or if you're single, it's one house by yourself. Got to be held by an individual as well. So you can't access this concession if it's sitting in a family trust or a company. You need to establish the property as your principal place of residence, so you need to live in it. The commentary around this says you need to live for at least 6 months, but importantly, it's not defined in the Act. So if you live in it for a shorter period than that and you have to leave suddenly, the ATO should accept that, providing you've got facts around that you have longer term intentions to stay in that property to establish it as your principal place of residence. For a lot of us back in Australia that may not move offshore and be expatriates, will just buy a house, live in it, and sell it. And during that time, you're effectively buying and selling a house, principal place of residence, with the full exemption, and you pay no capital gains tax on that property. They do have the absence rule, which is good for expatriates, which basically says once you've established the property as a principal place of residence, you get up to 6 years of 6 years of growth, or 6 years of deriving assessable income on that property, tax-free. Or if you're leaving it vacant, you can treat it indefinitely as your principal place of residence. And this is also something we can reset. So for example, for an expatriate that might first buy a property, live in it, establish it as principal place of residence, move offshore, work offshore for less than 6 years, come back to Australia, reoccupy the property, you've effectively just reset that whole period and you start again, which is good. So if you sold that property after that, you'd be capital gains tax free. I'll show you an example. All right, and staying beyond the 6 years, we need to do a pro rata allocation of that 6 years, and I'll show you an example of that in a moment. There's also a concession allowing 2 main residents at one time, which is basically for if you're buying a property and renovating it and living in another property, you can do that for up to 6 months without affecting the capital gains tax nature of the property. Now, what's the changes? So I've written 2017, 2018, because that was the budgets that it was originally brought in. Then I've written 2019, 2020, which technically it wasn't part of that budget, but it came in soon afterwards. So it was basically after the 30 June 2019, I think on the 1st of July, they removed the original bill, which just was taken out of Parliament. However, they brought in a new bill with a few changes, and it received royal assent around, I think it was 19th of December 2019, making it law. So the legislation removes the ability for foreign tax residents to claim the principal place of residence exemption. So basically, so most importantly, this is for foreign tax residents. And when I was telling you before, the capital gains tax event is something that happens in the year of the sale. So this is more saying if you're a foreign tax resident in the year of the sale, or at the time of the sale more so, you're going to miss out on the principal place of residence exemption. So this applies to the period when the property was occupied, firstly is your principal place of residence, any period of absence where the 6-year absence concession has been claimed. It applies from budget nights, 9th of May 17, there's a transitional measure. So for property owners prior to that, you receive up to 30th of June 2020, which is just around the corner. And the major change from the 17-18 draft to the finalised legislation is they've introduced a carve-out for significant life events in the first 6 years of the expatriate assignments, just things like terminal illness, death, and divorce. So, as I say, important thing to note is this is basically going to miss out on this concession if you're a foreign resident for tax purposes at the time of your capital gains tax event. Let's look at some examples. All right, so Tristan and Julia are both Australian citizens. They've got a main residence in Melbourne. They acquired in July 2013 for $500,000, and they lived in the property as their principal place of residence until January 2016. So you can see 2.5 years. They've established it as their principal place of residence, and then they got an expatriate assignment and moved to Singapore and rented out their property. Okay, they both decided to take advantage of this this concession and sell their property for $800,000 in May 2020, whilst in Singapore as foreign tax residents, which is otherwise known as a non-Australian tax resident for tax purposes. As they established the property as their principal place of residence and rented it out for less than 6 years, so it's January 16 to May 20, held the property on budget night 17, so we get the concession up to 30th of June 2020, and sold it before 30th of June 2020, So, and I've noted signed contract before 30th of June 2020. Settlement can be after. The property is sold capital gains tax free. Okay, so that's fairly straightforward. Okay, this is how the new rules work. So we've got same facts. So Tristan and Julia have got a property in Melbourne, acquired in 2013 for 500,000, principal place of residence till 16, moved to Singapore, rented it out. They decided to sell the property for 800,000 in July 2020 while still in Singapore. Even though they established the property as their principal place of residence, rented it out for less than 6 years, so January 16 to July 2020, held the property on budget night 2017, because they sold it as a foreign residence after 30th of June 2020, then there's no access to the concession, and the capital gain is calculated as follows. So sell price 800,000, purchase price 500. We've got legal fees, sales commission and stamp duty, a little bit of depreciation that they've claimed there as well, so that needs to be added back. We've got the gross gain of 286,000. There's no principal place of residence exemption, so they miss out on that. They do get an apportioned capital gains tax discount, which is 3 years over 7 years. So 3 years that they're living in Australia, over 7 years they weren't. So basically 3 over 7 by the 50%. So let's say they get about a 21, 22% discount there. Net taxable gain is 224, 112 each. Basically tax payable as a non-resident is 75,000. So literally a 1 month delay in that settlement has cost them 75,000. The important thing to note here is, okay, the gain on this property is substantial, but what if you had a property, for example, in Sydney that you lived in for 20 years before, as your principal place of residence before you moved offshore, rented it out for a couple of years and sold it offshore? These numbers will be a lot more dire. It's my job as a tax accountant to make sure everyone's educated on these changes, so you don't get tripped up. So what's the decisions that you need to make as a long-term expatriate? So, like I said, okay, you can sell the property before 30th of June 2020. And as I say, note the contract date. So make sure that contract's signed before 30th of June 2020. Settlement can be afterwards. And the sort of things that you might want to consider: is a property big enough for you and your family on return? Is it still the right fit for you when you return? Have you changed? Do you like apartment living? You know, do you are your kids grown up, and have they moved away? Looking at it as an actual investment, is it good investment in yield terms? So, i.e., you're not getting hit with super large land tax bills every year that are taking away your margin. Is your mortgage competitive? So, are you locked into a horrible mortgage with a steep repayment terms that you can't get out of? So then, if you do sell it, you know, realise the gain tax free if it's within the 6-year period, and invest the funds elsewhere. So, you know, things you can do: you can buy a future family home. Just got to know the transaction costs. So obviously, when you sell a property, you've got agents' commission and advertising. When you buy a property, you've got stamp duty, got legal fees both sides. And the future family home will obviously peg you into the property market. If you buy it with finance, you can get some tax losses built up there, maybe get some depreciation, and you can build up some tax losses whilst you're still working as an expatriate. But it's always important to look at the cash flows of that example, because the future family home can be expensive to maintain, even after the rent and the like, especially with things like land tax, which is getting a bit aggressive down in Australia. Or do you want to look at diversifying your investments? So if you've got a bucket of cash, as a Singapore tax resident, you can invest that tax-free in your own name up until the point that you return to Australia. So however, as I was mentioning there, property is always taxable, and that future family home example will be taxable up until the point that you move out of it, that you move into it. So, for example, if you buy that home, you rent it out for 5 years, and then you live in it for 15 years, and then sell it. So you've got a 20-year ownership. You're looking at basically a 25% taxable gain on sale, because 5 out of the 20 years it was an investment property, and 15 out of 20 it was not. Or do you want to keep the property until you return to Australia? So that's another point. So sell that property as a Australian resident for tax purposes. You don't have to move into it. You just have to be an Australian resident for tax purposes at the time of the sale. So you're still entitled to the concessions post 30 June 2020, provided that you're an Australian resident when you sell the property. Let's look at an example there. So property held until return to Australia. So we've got a similar fact pattern here. Acquired 2013, 500,000. Principal place of residence until 2016. Rented it until 2021 and returned to Australia to sell to upsize for 900,000. So sell price 900, cost base 500, legal fees, stamp duty, commission, depreciation, gross gain. Nothing is payable in this situation because the 6-year absence rule still applies, providing that you sell it when you're an Australian resident for tax purposes. You can live in a different state. That's absolutely fine. What if you're beyond the 6 years? Okay, so property held until return to Australia, but you're beyond the 6-year concession. So acquired in 500,000, principal place of residence until 2016, rented it until 2024, and returned to Australia to sell it to upsize for $1 million. I don't have to move it. So we're looking at renting it for 8 years in this example, and noting you get a 6-year concession. Got a slightly different calculation here, as you'll see. So we've got a sale price of $1 million. So hopefully the market value of your property's gone up. Cost base, we've got a new cost base here of 575,000 because there's a rule that basically allows us to elect a market value when you first derive assessable income on the property. So effectively at the beginning of that 6-year period. So that gives us an adjusted cost base of 575,000 as opposed to the 500. Had a lot of clients in Sydney that are able to uplift that cost base quite considerably because the market's gone up quite a lot from the point that they bought the property and settled into it to the point they started renting it out. We then deduct things like transaction costs and adjustments, etc. We saw in the other examples. I've just consolidated that. Gross gain of 360,000. We rented it for 8 years, remember, and we get the 6-year concession. That's locked and loaded, provided that we sell it, we're a resident for tax purposes. So that brings our gain down to 90,000. We get the 50% capital gains tax discount, but an adjusted version based on the time that we're a resident and the time we're not a resident. So we basically get 3 years out of 11 years, or 3/11 of 50%, gives us a $12,000 discount. Taxable gain of 77, which is 38 each. Tax payable of 30,000. So not so bad if you basically looking at bought a house for $500,000, selling for $1 million. So you've got a $500,000 gross profit there and only paying $30,000 worth of tax. So these calculations are worth considering. Okay, so what if scenario planning? So obviously with all new legislation, there's always it's always complex. I'd like to thank my good friend Noel Baharis from Australia, who's a good tax lawyer that I work with. He helped me with some of these questions here as well. What if scenario planning? So an expat received their late parents' former principal place of residence as a part of their will. So this is a situation that's actually probably could happen. So basically, you're living offshore, and sadly, your parents pass away, and in their will, they pass to you their principal place of residence. Now, classically, looking at the rules, you think, okay, if I sell this when I'm a non-resident, so I'm going to trip up on this principal place of residence exemption. However, there is a concession in this rule that allows you to receive that property as a non-resident of Australia for tax purposes, and it might have 20 or 30 years worth of principal place of residence exemption, which your parents, basically earned during the course of their period of time living there, providing that you sell it within 2 years of the estate, of the date of their death, which is the standard estate rules for principal place of residence. You're not going to pay any tax on that. So that's important to note because that's something that can happen. Now, how about some other things we look at? So what if an expatriate, so this would be a very sad situation, but an expatriate with a principal place of residence dies whilst being offshore, and they've been offshore for more than 6 years. So the new rules come into to provide this concession that says if you have a traumatic life event in the first 6 years, you can still access the principal place of residence exemption. So that's things like death, matrimonial settlement, terminal illness. In the situation where one of the expatriate passes away offshore and the property transfers to the living spouse, that's completely fine, providing that the living spouse sells it when they're back in Australia back in Australia as an Australian tax resident. So that's an important thing to note. If they sell it when they're offshore, they're going to miss out on that principal place of residence exemption. So that'd be a doubly sad situation. Also note that another situation, I was saying that there's no living spouse, the property transfers to an Australian resident beneficiary. They can sell it and access the concession because they're a resident for tax purposes. Slightly more common situation, it's also equally sad, as we have a matrimonial settlement post 6 years for expatriates living offshore. What if it's sold when it's offshore? The bad news is you're going to miss out on that principal place of residence exemption if you have a matrimonial settlement and you sell the property whilst you're both non-residents for tax purposes and you've been living offshore for more than 6 years. However, if it's transferred to one of the two spouses and then that spouse then takes it back to Australia and sells it or goes back to Australia and sells it when they're an Australian resident for tax purposes, you will receive the concession there. So that's the better situation. A few other random ones: compulsory acquisition doesn't happen too much in Australia, but if the council acquires part of your block of land or part of your land that had the principal place of residence exemption and they sell it, you're going to miss out on that principal place of residence exemption. And also selling the property to a trust. This is an interesting one that I had a client ask me about. You could, so literally if you've got a really nice property that you like, it's got a large principal place of residence exemption attached to it, you hold it as an individual and you sell it to a trust. So that the sale to the trust would be capital gains tax free because, or provided that it had that principal place of residence exemption intact on it. However, you would incur stamp duty at the trust level. So you need to weigh up the pros and cons of doing so. So once the property is in the trust, you miss out on any future principal place of residence going forward because you can't access that concession when your property is sitting in a trust. Also, if there's a bank involved, you need to make sure they're on board with the transfer because some banks don't like lending to trusts or the terms may not be as favourable. And also, if you make a loss, if you've got a property in a trust and you make a loss in that trust, that loss is trapped within the trust until you've got taxable income in that trust to offset it. So the worst thing you want is an investment property sitting in a trust with a big loss in there and you're back in Australia earning taxable dollars in your own name and you're unable to benefit from those losses in the trust. Okay, so action items here. So looking to develop a capital gains tax strategy. So considerations to develop a capital gains tax strategy. Are you going to preserve the 6-year absent concession? And by preserve it, it's basically looking at either selling the property pre-30th of June or moving back to Australia to sell it when you're Australian resident for tax purposes. Do you know how much it's worth? That's a good question. Show me the money, basically. Moving back into a property to re-establish it as your principal place of residence. So this is another question I get asked a lot. Is clients say, okay, I've been living offshore for a long time now, and this will be more than 6 years. Should I move back to Australia to move back into the property to sell it and get a tax concession? How the concession is calculated is an apportionment method based on time. So literally, if you've been renting the property for 10 years and you're going to move back into it for 6 months, it's not going to make much of a difference to your principal place of residence exemption. So it's always worth running the numbers before you make major life decisions like that, because it's a big hassle to move back into a property just to sell it. Is your property too big and small? We spoke about that before. Acquiring a future family home now, renting it out ready for you in the future. That's definitely an option. Consider the tax for that. And consider selling your property later in life when you have a lower marginal tax rate. So if your property is good, you don't want to sell it, you may not move back into it, which is fine. You can just hang on to it as an investment property. You've got that 6 years preserved. You've got the time that you lived it before that preserved, providing that you sell it as a capital gains, as a Australian resident for tax purposes, and sell it later in life when you're on a much lower marginal tax rate. So in retirement, when maybe you're receiving tax-free income. The more time in Australia means more of the 50% capital gains tax discount, as we discussed. And other things is if you do sell that property, understand the tax consequences for property and other asset classes. So important to note, investment properties are always subject to capital gains tax in Australia, and no concessions for foreign residents. Investment properties are always subject to income tax. So if your property is does not have sufficient negative gearing there, you're going to pay income tax. You might better offset that with such things as a deductible superannuation contribution, providing you do it before 30th of June. And also note, obviously, heavy transaction costs for the property. So stamp duties on the way in, land taxes throughout for some people, sales commissions, legal fees, etc. And we've got foreigner surcharges as well. So I've got some clients that are unfortunately suffering the foreigner surcharges simply because they might own Australian property, but they may not be an Australian citizen. They might just be a PR. So if you're a PR and living offshore, you're going to cop that non-resident land tax, unfortunately. Alternates to property. So if you're looking to diversify, I'm a big fan of diversification from a tax point of view. Shares, bonds, and managed funds. So purchasing shares, bonds and managed funds when you're a Singapore tax resident are tax-free during your time in Singapore, providing you purchase them in your own name. If you have shares, bonds and managed funds that you brought from Australia, you may not be taxable on the income. However, you may be taxable on the eventual capital gain of that if you haven't had a deemed sale when you've left Australia. Superannuation should always be considered. It's important to note that superannuation, regardless of your residency, the access rules remain the same. So currently the rules extend that you can access your super when you're 16, retired or 65. Note that super is always a taxable environment. So if you're making a contribution to super, each year you're going to be subject to a 15% earnings tax and 10% on capital gains in Australia, when alternately you could invest in Singapore tax-free. And offshore bonds are quite popular here. Quite a great structure for tax purposes. Tax deferred up into 10 years and tax-free after 10 years in Australia. So also a really good vehicle for looking to repatriate back to Australia. Okay. I love talking about tax, as you probably figured. I'd be very happy to have a catch up with you to talk about tax as well. Everyone's situation is different, so obviously the information in this seminar is quite general in nature. We can catch up to talk more specifically about your situation, and I can do a little capital gains tax calculation for you on the board to see, just to help you make that decision whether you keep or you sell. Questions and answers. So I might hand this over to yourself, Ben. I've just got my top tax tips there on the board for property, in case you're interested. But yeah, thank you for everyone for listening, and over to you, Ben, if there's any questions.
Yeah, thank you very much, Tristan, and thanks for running through a fair bit of content there. So I sort of picked out you've got to be careful of your wine collection, and when you buy and sell it, didn't seem to be taxed on drinking, and there's a few more options on what we can sell today. So I think, look, tax is an endless source of change in Australia. I think it has a lot of impact on where we're working. So getting that insight into thinking about your time offshore and how to handle your primary resident. And often I think primary residence is people's biggest asset. So the tax can be a quite big decision there. So, and I also picked up that we definitely need to check your tax residency when you're selling, as that'll have a big impact. So we're going to open up to a bit of Q&A now. And if you'd like to ask any questions, please feel free to write onto the Q&A tab on the Zoom browser. So we've got one question that we'll start off with from Vishnu. And Tristan, it's to clarify again, please. I have a residence in Melbourne. It has been my main place of residence, acquired in 2010. I'm now a non-resident, and if I sell before 30th of June 2020, I will not be subject to the new capital gains tax.
Okay, thanks for the question, Vishnu. We need to look at the 6-year exemption and how that would apply to your property. So basically, if you've obviously established it as your principal place of residence, so you've bought the house in 2010, you've moved into it as an Australian resident for tax purposes, lived in it, and at some point you've then started to rent it out and move to Singapore. So if you've only rented it out for less than 6 years, and you sell it before 30th of June 2020, that property will be capital gains tax free. If you rent it out for more than 6 years, we look at the apportionment method. So you'll still access that principal place of residence exemption, providing you sell it before 30th of June 2020. However, there might be some tax payable if you've rented it out for more than 6 years.
Brilliant. Thanks, Tristan and Vishnu. I hope that answered your question. So again, if anyone's got any questions, just to put them in the Q&A tab. I've just got a few from my side, which will sort of stretch you from just tax into some other areas. So just from your view, what's driving these tax changes? I think there's a lot of change in, especially in how expatriates are taxed in Australia. Can we get your view on what's driving this?
Yeah, no worries. Look at I guess this is my personal view, but my personal view is originally these changes came about because of the pressure, the pressure of pressure on house prices in Australia being driven up, uh, and specifically related to foreign buyers of houses. So a foreign purchaser could effectively place one of their family members in the house, put it in their name. Family member would live there for a period of time, and then you could sell it capital gains tax free, providing that you've established it and earn no income from it. So I think these changes were originally originally developed to help curve that kind of loophole for foreigners to come in and purchase property and access a concession that's only available for, for those that live in the property. However, I think expats have been caught up in it. This change did get caught, did obviously get caught in the consultation stage for a long period of time, a number of years, before it eventually resurfaced after lots of consultation, lots of lobbying, and got a few carve-outs. But unfortunately, it's still unfair for expatriates. I don't think that was the original intention, but I think it's just worked out that way.
Okay, brilliant. And just one other question there is, so where do you see the major mistakes or pitfalls from Australians in Singapore in relation to tax? So what are even outside of property, where are the major areas that people fall victim to the tax man, let's say?
That's a good question. So normally a few areas I always look at. So for those being unaware of what we call the deemed sale rule for shares. So for example, if you've got a parcel of shares that you've had in Australia, you've moved to Singapore, and at the time of moving to Singapore, you've done your part-year residence return, and you held some Australian shares. There's a number of people out there that aren't aware that you can disconnect those shares from Australia for tax purposes by booking effectively a dummy capital gain. And that means that any further growth that you enjoy during your time in Asia will be capital gains tax free. So that's one little, one good thing to note. Other things is, I guess with the potential change that we've got coming up, it's just an education piece. I'm worried that there'll be people that will have their just busy working, looking after their family and living life in Asia, and then they'll decide to sell their property and just get accidentally tripped up by it. So I've got the bad feeling that I might be the one that might get to deliver the bad news to them when they come and see me. So I'm doing my best to educate everyone. And look, there's other things like misunderstanding of the residency principles, and also, ensuring that people do understand the residency principles as well for when they might send their wife and kids back to Australia and still remain in Singapore, or their understanding of when they are a resident, when they are a non-resident for tax purposes.
Brilliant, thank you. So I've got another question from Andrew Cox. It's after 6-year exemption of CGT expires, how do they calculate the CGT? For example, if house sold after 10 years, is it taxed on 40% of the gain, regardless of how much the market actually moved?
Yep. Yeah. Good question. Thanks for the question, Andrew. Yes, it's calculated on a straight line basis. So in that sort of situation, so assuming that you're selling the property as a resident for tax purposes, you've rented it for 10 years. The uplift you get is a market valuation when you first start to rent it. So that's something you can do. So if you just use some silly numbers, you bought it for $100, and 5 years later when you start renting, it's worth $200. $200 becomes your cost base, providing you get a market valuation for that. You then rent it for 10 years and sell it for $400. So we're looking at a $200 gross gain. And effectively, in the short answer is yes, it'll be 40% of that $200 that you'll be paying, which is basically you get the 6 years locked and loaded. You've rented it for 10 years, so you taxed on four over the 10, so 40%. So, and that is unfortunately regardless of whether the markets moved disproportionately over that period. Unfortunately, the only market valuation rules that you can apply is when you first start to drive assessable income on the property. So that's when you first start renting it. And you can also get a valuation in May 2012 to help you with that 50% capital gains tax discount if you were offshore at the time.
Brilliant. So just another question around, you mentioned property, you mentioned shares. There was a small conversation there on offshore bonds. How does someone take advantage of offshore bonds? What are they, and what advantages does it provide?
Yeah, no worries. Offshore bonds are they're basically a popular vehicle for a lot of expatriates investing simply because they have flexible rules in a lot of different jurisdictions. So the UK provides it, Japan, I think Italy to some respect, and most importantly, Australia. So Australia provides concessions for the offshore bonds, basically providing that you hold them for 10 years, and there's a contribution rule as well. So a lot of the time, the offshore bond is effectively an investment account with a tax benefit wrapped around it. Within the bonds themselves, you can buy shares, you can buy managed funds, and alike. And basically, once you hold these bonds for 10 years, from the point you set them up, subject to what we call a contribution rule, 125%, meaning you can't put more than 125% of the previous year's contributions, then they'll be tax-free eventually in Australia. So it's a nice sort of alternate to superannuation, and quite a nice flexible vehicle. And the ATO has a view, not that it's legislated, that they need to be set up when you're a non-resident for tax purposes.
Brilliant. And just sort of a final question there. Are there any other areas of big opportunity that you see for making the most of your time in Singapore?
Yeah, look,
from a tax perspective.
Yeah, thanks, Ben. Look, I think it's important to have a, I guess from this tax accountant, I think it's important to have a plan. Make sure your money's working hard for you. Things like having a nice diversified portfolio of different assets that are all growing for you, such as, you have a property, but you can negatively gear it. You've obviously got your superannuation, but consider when you're putting money into the super, maybe consider not to put it in too early, but obviously based on their own circumstances. Consider the offshore bonds as another vehicle. Consider directly investing in Asia as well, and building up a nice pot of assets here tax-free. And just before you go back to Australia, then you can do things like cash in assets in Singapore tax-free, pay down future non-deductible debts on your property that you're about to move into, make lump sum contributions to your superannuation and the like. It's really basically just take advantage of the fact that we're living in a tax-free jurisdiction here at the moment, and make sure you understand how the rules work in Australia for tax purposes.
All right, thank you. I believe we've got... Sorry, I didn't scroll down. We've got one more question here from Tiffany Wang. What happens after 30 June if an Aussie moved to Singapore and buys a house in Sydney? Would there still be a less than 6-year concession?
Yep, good question, Tiffany. Thanks for writing in. So I'm assuming, I have to make some assumptions here, but I'm assuming that we've got an Australian living in Australia. They haven't moved to Singapore yet. They buy a property and establish it as their principal place of residence. As we discussed, live in it for at least 6 months. Post 30 June 2020, they moved to Singapore. And then live and work in Singapore. So because they've established the property as a principal place of residence, they're still going to be entitled to the principal place of residence exemption. They'll still get the 6-year concession as well, provided that they sell the property in the future when they're an Australian resident for tax purposes. So, my advice to that particular expat is basically, if they're moving offshore, to don't sell your property when you're offshore, or if you have to sell it, at least understand the tax consequences of selling it versus holding it. And basically just retain that property until you return to Australia. So I think a major change that in the behaviour of expats that this new legislation will have is expats will stop selling their family homes offshore, obviously, because it won't make financial sense to do so. And it's more just, it will be a buy and hold strategy, rent it out, and then eventually when you return home, then you can either move back into the property or sell it if you want to.
Brilliant. Thank you very much, Tristan. So do you have any final comments or thoughts you'd like to share with the webinar before we...
I think that's it. I guess diversification and education is my message here. I love talking about tax. So if anyone has any further pressing questions, my email is on the screen there. Feel free to write in. I'd like to answer. I believe we're going to make the slides available as well in case you'd like to share them. So if you would like the slides, you could write into me and I'll send them, send you a copy your way. I'd love to catch up and have a talk tax anyway. But the main message to everyone is just make sure you understand your options, do the calculations, and basically get educated on this change and how tax works for expatriates.
Thanks, Tristan. Nothing better than a love of your work. So thank you very much for your insights and sharing I think a fair bit of stuff there on how we can make the most of our time in Asia.
Thank you.
So for everyone else, thank you very much for joining us today, and thank you for your continued support of the Chamber, especially through these challenging times where we can't get together as much as we'd like face to face. So we will continue to roll out webinars on different topics, as I mentioned at the start. Don't forget to renew your membership. I believe that's coming up, and we'll keep communications open and we'll be adjusting as a chamber depending on the external situation. So I hope everybody stays safe, and thank you again for joining us today, and look forward to catching up with everybody in the near future. Thank you very much.